Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent FOMC. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, we heard from Powell today at the most recent FOMC. The Fed decided to keep interest rates unchanged, so we are still looking at 5.5%. You can see that the Fed hit the terminal rate, or what is theoretically the terminal rate, back in July. And we sort of talked for a long time. I think maybe about a year and a half at this point, that 5.5% could very well mark the terminal rate. One of the reasons that 5.5% came to mind was it seemed like we needed to go well above where inflation was, right? So if we were to overlay the United States headline inflation rate, you can see that the Fed funds rate and headline inflation actually crossed at around 4.5%. And then it seemed reasonable that we would need to go up to a level that would be well above where inflation is in order to ultimately bring it back down. And you can see that's actually a common thing during inflationary cycles, that the Fed funds rate goes above, right? And actually, we'll just put it on the same scale so that we're actually comparing the same thing. So let's go ahead and go over here, and we'll put United States inflation rate, same scale. And you can generally see that during inflationary cycles, right, the Fed funds rate, this white line, tends to go above where headline inflation is. That is often, I think, needed in order to durably bring inflation back down. Now, we just did a video not too long ago about inflation and how difficult it is to go from 3% to 2%. Just for sort of a quick recap, you'll notice here in the 70s, in late 60s, there were a number of times where inflation would fall. Here it fell from like 6.5% back down to 3%, and then it accelerated back up to the upside, and we got another wave of inflation. And then over here in 1974, it fell all the way down from 12% to around 5%, and then accelerated back again. So getting those last percent, like that's the hardest part, that last percent or two, to get inflation back down to 2%. And what happened over here is that the Fed kept sort of shifting from QE to or shifting from tighter monetary policy to looser monetary policy, right? Going from higher rates to lower rates. And because of that, the market kept sort of chasing the next narrative, right? Here it was, inflation is going up, market needs to go down. Here it was, inflation's going down, market needs to go up. Here it was, inflation's going up, market has to go back down, right? It was the same thing over and over. It was just chasing whatever the next narrative is. And we find ourselves in a precarious position where inflation is back down to 3%. So the ultimate question is, has the Fed done enough, right? Has the Fed done enough? One of my views for a while is that 5.5%, in my opinion, although I could be wrong, right? But my opinion is that 5.5% is likely sufficiently restrictive. The only catch to that is while the rate might be sufficiently restrictive, it also needs to be held there for a sufficient period of time to actually durably get inflation back down to the target. Historically, as Powell said earlier today, if I just sort of pull up what he said a number of things. But one of the things that he said is there's little basis for thinking that the economy is in a recession now. There's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. No one is declaring victory. That would be premature. So Powell is obviously saying, look, there's a chance that a recession comes into play here. And history shows that there's a decent chance that happens. I mean, if you look at all these inflationary cycles, they tend to correspond to recessions, right? Like they tend to correspond to recessions. It doesn't mean that you have to have one, but historically, that is what has ultimately happened in order to get inflation back down and then a recession sort of set in. And, I was unable to watch the meeting live today. I just wasn't I wasn't by my computer when it was going on. But just simply looking at the bond market, I could tell that Powell was in fact coming out very dovish, right? If you were to look at TLT, you can see that it was popping all the way back up to almost 97. Almost 97. Now, the bond market, TLT is something that I'd been watching for a while, and back over here, I was not convinced that higher for longer was priced in. Back over there in like in January, February, March, April, May, June. And I was very vocal about that I did not think higher for longer was priced in. But then we got this move, right? Then we got this move right here in Q3 of the pre-election year, which allowed risk assets to fade, which they often do when you get a bear steepener. Bear steepener means it's bearish for risk assets. That we had a correction in the S&P about 10 or 11%. My understanding, as I've said a number of times, is that when the bond market dropped, right, when TLT dropped, when the 10-year was going up, the 20-year was going up, that was when higher for longer finally got priced in, right here. When crypto Twitter was screaming that, the bond market was only, the TLT was going to keep dropping and the yields were just going to keep going higher, I did not share that view, right? And I was very vocal about that. And actually the sort of the view that I've shared on ITC Premium for a while was that 80 to 85 could mark the low on things like TLT. So, it didn't even go all the way to 80. It went down to about 82. But that's been my general view that, somewhere around 80 to 85 was sort of the level that it could ultimately bottom out at. And, I'd been waiting for that level for quite a long period of time, and then it finally came. So once we hit this level, my view, has been that higher for longer has been priced in, and therefore locking in, some of those yields is, was not the worst idea in my view, because there's a good chance, there's a decent chance that we're going to be going back to some lower rates in the not so distant future. Now, what did Powell say that makes the market think that we are going back to lower rates? If you were to go look at these projections over here, let me reload this because it seems like it's actually changing, quite a lot recently. If you look over here, the market is pricing in a rate cut in March. And we talked about this in the video that we just did a couple days ago, that we could see a rate cut as early as March. The market is even saying there's even a 20% chance, 21% chance of a rate cut in January, although I think that might be a little premature. Market is saying, hey, 70% chance the Fed cuts 25 basis points by March. But it does not stop there. The market goes on to think another rate cut in May, and another one in June, and another one in July, and then another one in September, and then another one in November. So right now, you can see that there's 6 rate cuts being priced into the market, and the market is saying by the end of 2024, the Fed funds rate should be at 4%. Now remember, the market is often wrong, and one of the reasons for that is because you're looking at probabilities that are likely a combination of two likely outcomes, the most likely outcomes that the market participants are betting on. Number one is a soft landing. Number two is a hard landing. So the first option, a soft landing, would likely require nowhere near 150 basis points of rate cuts. 150 basis points of rate cuts is likely only happening if the economy goes into a downturn. On the other hand, if you get a hard landing, it might suggest that even 150 basis points of rate cuts isn't sufficient, right? So and I've said this before, what I think we're seeing here is a bimodal distribution. And what I mean by that, let me go show sort of what I'm talking about over on one of these charts over here. So let me just pull up interest rates just so we kind of have it on the screen. When I'm sort of saying a bimodal distribution, I'm basically saying, look, there's some people that are betting on, a soft landing, right? And they're thinking that, that rates will, they're sort of saying, okay, the highest probability is that the rate goes to, let's just call it X, right? But then you also have people that are saying they're betting on hard landing. And so what they're thinking is that rates will go, to Y, right? They're saying rates will go to Y. Some people are saying rates will go to X. And so what you end up getting is sort of a combination of these two outcomes, right? So you're not looking at just the market thinking it's a soft landing or, a hard landing or a soft landing. What you're seeing with this is the result of both camps sort of combining together. So if there's a soft landing, you're likely not getting 150 basis points of rate cuts. If there's a hard landing, you're probably going to get more than 150 basis points of rate cuts, although maybe 150 is enough. History would lead us to believe that it likely wouldn't be enough. If you were to look at interest rates, and you were to look at just say the last few recessions, not including the pandemic, but I mean, even if you include the pandemic drop, you can see that interest rates went from 2.5 down to 0, essentially, down to 0.25. So here, interest rates dropped by 225 basis points. But if you go look at 2007, you can see that the Fed funds rate, the terminal rate was at 5.25, and it went all the way down to 0 or 0.25. If you look at the dot-com crash, rates were at 6.5%, and then ultimately they went all the way down to 1%. So if you get a hard landing, right? If you get a hard landing, it's hard to believe that the Fed would just go down to 4%, right? Like that's not really suggestive of what prior hard landings have looked like. But if you get a soft landing, I don't know that it makes sense to go down to 4%, right? I mean, it would almost seem like if you get a soft landing and you're going down to 4%, you're really risking inflation starting to reaccelerate back up to the upside like we saw back in the early 1970s and the mid 1970s. So there's a fine line that has to be walked here between if it's a soft landing, you don't want to cut too much. If it's a hard landing, you need to start cutting yesterday, right? I mean, and again, that I think is what Powell is seeing, is that there are some cracks showing up in the economy. Make no mistake about it. Powell came out today more dovish than I have seen him in a long time. For the last, and I've watched every single meeting going back years at this point. Every single time I've seen him talk, for all of 2022 and all of 2023, he's been hawkish. He's given no leeway to the idea of rate cuts anytime soon. It has been higher for longer. It has been, we're going to stay the course until the job is done, and so on and so forth. But today, was singing like a dove, right? Completely different. And he said that there are signs. He said that recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. So clearly, they see the economy slowing down, right? Clearly, there's indicators that would suggest the economy is slowing down. GDP in Q3 came in at like 5.2%. The Atlanta Fed, I think right now, is projecting for Q4 down to 1.2%, and it was at 2% not too long ago, and it's come down to like 1.2%. So there's definitely signs that the economy is cooling off. And so we must understand that the reason they're even suggesting rate cuts could come as early as next year is because there's potentially signs of weakening in the economy. If you were to go look at the SCP, or the Summary of Economic Projections, you can see that the participants basically are just all flat here because they're not doing anything in the last meeting, and they're just keeping rates. They know what they're going to do. But if you look at 2024, there's only 2 participants that thinks rates will stay where they are throughout all of 2024. There's one participant who says we're going below 4% in 2024. Here's one participant that thinks we're going to get 1 rate cut. And when I say rate cut, let's just think each rate cut as 25 basis points, because you could always have 1 rate cut that's more than 25 basis points. But you have one participant here that thinks you're just going to get 1 rate cut. And then you have, 5 that think you're going to get 2 rate cuts, and so on and so forth, right? Like, there's even more that are saying you're going to go down to 3 rate cuts, and more that are saying you're going to get 4 rate cuts. And there's one person, again, that thinks you're going to get all the way down here to, just around 4%, maybe a little less than 4%. So it's clear, right? It's clear that the FOMC participants are leaning in the direction of rate cuts next year, right? It's very clear. And so because of that, these probabilities have shifted. Look at the compare tab over here and look at what the market is thinking. Today, let me go to the March meeting. So if you look at the March meeting, you can see that a month ago there was a 10% probability of going to of a rate cut. A week ago there was a 54% probability. A day ago a 40% probability, and now today a 70% probability of a rate cut by March. So the market's paying attention to what Powell is saying. They're paying attention to the SEP.
the market thinks they're going to cut. And I agree. I mean, I do think they're going to cut next year. He did say that they're not politically motivated in any way. He said, we do not think about political events. We don't think about politics. We think about what is the right thing to do for the economy. Look, guys, I mean, I've said for a long time, what happens? Looser monetary policy comes in election years, right? That's one of the reasons why, and again, I'll just sneak it in, right? But that's one of the reasons why Bitcoin dominance often doesn't go that much higher in election years or the halving years, is because we're going back to looser monetary policy. And that's why, and then you get to a period where, that looser monetary policy kicks in at some point in the halving year, if not before, and therefore higher risk starts to no longer bleed as much to lower risk. Okay? So it's an election year. There's going to be some pressure, to go back to more accommodative monetary policy, right? I mean, they can say they're not politically motivated, and I'm tempted to take him at his word, but there's also this idea of if you're a political party, are you really going to want to go into elections with all these companies, going bankrupt and laying people off without any type of relief in sight? Or do you want to go into elections having a few of those rate cuts so that businesses can start to feel at least some relief? The hard part with this is knowing how much relief will be needed in order to avoid a recession. One of the things that Powell said was the reason you wouldn't wait to get to 2% when referring to inflation to cut rates is that policy would be too late. You'd want to be reducing restriction on the economy well before 2% so you don't overshoot. We are aware of the risk that we would hang on too long. We are very focused on not making that mistake. Let me just show you how these, the last couple of economic cycles have played out with respect to the S&P 500. So, what do you notice here in this cycle? What you'll see is that once the Fed paused, the market continued to rally, right? So here is the pause. During the pause, initially there was a sell-off, and then the market rallied. But the market topped out at around the time that rate cuts began. The problem is that while rate cuts began, it wasn't enough to really get the economy back on track. And therefore, the S&P continued to sell off. The S&P bottomed by the last rate cut. Okay? Look at the cycle before that one. Here's where the Fed paused. Right there. Here, the market started to sell off before the Fed started to cut. And again, the market did not bottom until you got closer to the end of rate cuts, right? It wasn't at the very end, but pretty close, within a few months or so. So I'm not suggesting that this cycle has to play out like the last two cycles. There's certainly a strong likelihood that it plays out in a different manner. And so you should not go into this thinking that it has to play out the same way. We could go back to other cycles. They're a bit choppier, right? It's not as clear. I mean, in the 1970s, they were just all over the place, and it made the market just constantly chase whatever the new narrative was. But again, going back to the 1970s, you can generally see that, the market tended to find a low after the Fed started to cut rates, not before. So that is what we have generally seen, although it's not always been the case, right? There are examples of soft landings. I think 1967 is one of them. And that's a good case study, for anyone interested to take a look at what happened in 1967. And even then, we still got a recession 2 years later. Another way to view this, and by the way, just sort of keep this up on the screen. This is what it looks like today, right? So, and let's just put this out towards March. Remember, March would actually put it at around the median number of months, I believe, or about the average number of months that the Fed pauses before they typically cut. And I've said that a number of times. If you look from when they hit the terminal rate, 8 months after the terminal rate puts you in March of 2024, which is about the average amount of time it takes. And that's exactly what the market is expecting, that the first rate cut's going to come in March. Now, since the Fed paused, what happened? You got a sell-off, which has also happened a couple of times before. And then ever since then, the market has had a pretty nice rally. That usually happens, right? That usually happens. And I mean, I think right now the market, there's a lot of people sort of banking on a soft landing.
Maybe they're right, right? I mean, maybe they're right, but a lot of people are banking on a soft landing. The problem, of course, is we're not going to know, how much effect all these rate hikes are going to have until we're, in 2024, and we're seeing if the unemployment rate is starting to slow down or not. If you were to overlay the unemployment rate onto this chart, let me make it a different color so that it stands out a little bit better. You can see here the unemployment rate started to go higher, which is why the Fed's likely started to cut. Right? The unemployment rate was going up, the Fed started to cut here. Unemployment rate started to go up, so the Fed started to cut. Yet again, the unemployment rate, you can already see it. It's starting to go up again. And because it's starting to go up, the Fed is saying they're probably going to start cutting soon. It's really fascinating how it seems like things are playing out in a similar way, but we all want to believe it's different. And maybe it is, right? Maybe it is. I don't mean to imply that we can possibly know the ultimate outcome of this. But that's just what previously happened. Now, we can also overlay the 10-year yield, right? So overlay the 10-year yield onto this chart. And what you'll notice here, let me extend this up. Oops. What you'll notice is that in 2000, just before we hit the terminal rate, the 10-year yield topped. In 2007, 2008, you can see the 10-year yield topped just before we got to rate cuts. And there was also another meaningful high right here as well. This high did not hold, but also note that this high did not hold during a period where the unemployment rate was still going down. This high did hold, but it was also after the unemployment rate had started to turn back up. So I've suggested, many times as I was talking about with the bond market earlier, that there's a decent chance the bond market has bottomed. And you can see the 10-year yield has potentially put in a convincing top up here. Normally, after the 10-year yield puts in a top, risk assets like it, right? I mean, even over here in 2007, after the top, risk assets liked it for a while. Over here in 2000, the 10-year topped here, risk assets rallied for a couple of months. Maybe even more, maybe more than just a couple of months. So that's actually really common to see. And we've said this before, right? As the long end of the yield curve comes down, the general reaction of markets is to like it because it takes that pressure off, right? There's no longer that hold on risk assets where if the long end of the yield curve is going up and the risk-free rate is going higher, then that's going to be competing with equities. Why would someone take on the risk of maybe getting 8% in the market if they can get 5.5 or 6% risk-free? So as the long end of the yield curve comes down, though, there's no longer that same incentive, okay? Now, where it gets complicated is what happens next. What happens next? Because initially, markets really like the long end of the yield curve coming down, right? They really do. The problem is if it continues to come down. Now, the Fed does not control the long end of the yield curve. It controls the short end of the yield curve, right? It controls the short end. That's why, when you have the Fed funds rate at 5.5%, that's why the 1 month is almost 5.5%, right? The 2 month is 5.4%. So is the 3 month 5.4. The 6 month right around 5.4. The Fed controls the short end of the yield curve. The Fed does not control the long end of the yield curve. They don't control the 20-year, right? Maybe indirectly based on their monetary policy over long periods of time, but they do not control the long end of the yield curve. This is the 20-year. This is the 20-year. You can see that it's potentially starting to break down here. It doesn't mean that it can't back test this trend line at some point, but it is potentially starting to break down. Now, the reason why that's important is because if it were to go back up, it would likely mean the market thinks the Fed funds rate is not above the neutral rate, right? So let's think about this for a second. If the neutral rate, right, so you have R star is the theoretical rate at which if Fed funds is above R star, the neutral rate, then the economy contracts. If the Fed funds rate is below R star, then the economy expands. So let's say R star, let's just guess, I don't know what it is, but let's just guess that it's 4%, right? What that means is that as long as we're at 5.5%, it's going to put downward pressure on economic activity, right? It's going to make the economy slow down. But if you're at 3.5%, it would then theoretically make the economy speed up. There's no way to know what the neutral rate is. And Powell even said, I mean, like, people will be talking about it in 10 years, but they have the benefit of hindsight. They have the benefit of knowing what the stock market is going to do and the economy is going to do for the next 2 years. We don't, right? We don't have that benefit. I mean, people are guessing what's going to happen, but we don't know for sure what's going to happen with the market. We don't know for sure what's going to happen with the economy over the next couple of years. If it turns out the economy expands from here, then you could argue that we're not above the neutral rate. But if we are above the neutral rate, which I think we are, then we would expect the economy to slow down. And we are seeing it slow down as GDP, again, this quarter is projected only at 1.2% so far, which was, a lot lower than what we saw last quarter at over 5% annualized. So when we think about the neutral rate, is the Fed funds rate above the neutral rate? If it is, right, if it is above the neutral rate, then it should continue to lead to downward pressure on inflation, meaning that even if the Fed were to start to cut, even in January, inflation could still come down. I think inflation is still likely to come down. If you were to look at the year-over-year contributions per category of inflation, one of the things you'll notice, and I pointed this out in the video I did on it just a day or two ago, 2.31 of the 0.3 of the 0.3 or the 3.12, 2.31 and 3.12 is coming from housing. And housing lags a lot. Housing lags a lot, right? If you go look at just the year-over-year per category and you were to look at housing, it didn't even top out until February 2023. You compare that to, just general headline inflation that topped out in June of 2022, more than half a year earlier. So this component is still going to likely be coming down for many, many months, right? So that's going to provide a headwind for core CPI. Right? It's going to provide a headwind for headline inflation. So because of that, I still think inflation is more likely to go down than up. I could be wrong if the Fed funds rate is not above the neutral rate, right? So if we're not above the neutral rate, then the economy would start to expand again, especially as we get rate cuts, right? And it's possible that the neutral rate is 5.25, and the minute they go below 5.25, it's possible the economy starts to expand again, right? Again, this is all a theoretical concept, and some economists don't even believe in a neutral rate, right? But it's just an abstract idea. So the thing to consider, though, right? The thing to consider in this situation is the Fed, again, I said this before, the Fed does not control the long end of the yield curve. They don't control it. So if the 20-year is dropping, then what it means at this moment, again, things can change overnight. I mean, maybe we'll wake up tomorrow and it's back up, but what it means at this moment is that there are enough market participants thinking that the economy is slowing down and slowing down quickly, because the 20-year was at almost 5.4% just a couple of months ago, not even 2 months ago. And now it's at 4.3%. That is a huge change in a really short period of time. Okay? It's a big change in a relatively short period of time. And so I think what we have to consider is, because the Fed doesn't control the long end, if the market is sniffing out weakness in the economy, then they think that this is going lower. Why would they think that? Well, if there's weakness in the economy, then inflation is going to be the least of our worries, right? Like if a recession actually materialized, and again, anytime I ever mention the word recession, people get up in arms about it. Guys, recessions are a natural part of the business cycle. Sometimes we get them, sometimes we don't. Okay? It's okay to talk about them. There's no way to know if it happens. We're only going to know with the benefit of hindsight, but there's a decent probability that it happens. And even Powell said, there's a decent probability that it happens. He said, What do you say exactly? There's always a probability that there will be a recession in the next year, and it's a meaningful probability. Now, I know all of us are think, or a lot of people think that they're smarter than everyone at the Federal Reserve. But I do not think that, right? I do not think that. I think there's a lot of smart people over there. And if Powell is going to say that there's a meaningful chance of a recession in the next year, there's a meaningful chance of a recession in the next year, right? Doesn't mean that it has to happen, but there's a meaningful chance that one happens. So if the 20-year drops, right, if the 20-year yield continues to drop, then what it means is that the market does not think that inflation is the biggest issue anymore, right? The market is saying, hey, inflation is coming back down. All you have to do is give it time. The bigger issue you have to worry about is, has the Fed gone too far? And have they pushed us into a recession? Because if we go into a recession, inflation will take care of itself, right? If we go into a recession. That's what the market is currently concerned by. Powell mentioned that the labor market has been returning to normal. One thing I wanted to mention, and I showed this the other day, this is job openings per unemployment level. So basically you're looking at the number of openings per unemployed worker. That's what it looks like, right? So there's been a lot of excess. We're almost back to the pre-pandemic high. The problem is that this is dropping quickly, right? And this, if you think about it, the numerator is job openings, and the denominator is the unemployment level. The reason why this is an issue is because job openings, right? Let me just pull it up over here. Job openings are dropping pretty quickly. So the numerator is dropping. It's going lower. Whereas the denominator, the unemployment level, right? So the unemployment level is going up stochastically, right? It's not a linear trend, but it's stochastic. So you have the numerator going down and the denominator going up, meaning that when that happens, this metric falls off a cliff because both are working in sort of both are going in the wrong direction for this metric to stay elevated. And so this here really does suggest that the Fed is sufficiently restrictive, right? And the thing they have to do is hold here long enough to return to normal levels. Okay? Now, imagine if they started to cut rates only after this reached all the way down here at 0.9. It's too long, right? They waited too long. Because in the same way that rate hikes take 12 to 18 months to filter through to the economy, so too do rate cuts, right? You're not going to cut rates and then immediately every small business in the nation is going to feel that relief just because the Fed cut 25 basis points, right? It's not going to mean anything. So I'm kind of the opinion, honestly, that if you really want to believe in the soft landing, the Fed needs to start cutting yesterday because this is already dropping a lot. I mean, it still shows that there's 1.34 job openings per unemployed worker, so there is still some excess. The problem is that this can drop really quickly. I mean, last month it was at 1.47, and then it dropped to 1.34. So, if you think about it, like by March, you have 3 more data points. Where is it going to be? The problem is that by March, it could be down here at the pre-pandemic levels. But if you start cutting in March, that doesn't mean that this metric just immediately stops, right? It would probably continue to go to the downside for months until the economy starts to feel the effects of those rate cuts. So the soft landing scenario is really banking on the Fed coming to the rescue quickly enough. And we will see if they are able to do that or not. But, still, so far, the trend is certainly not favorable because of the rate at which this thing is dropping. If you think about it, once you get to a level below 1 where it's going down, it means that for every unemployed worker, there's no longer enough job openings. And that's where the unemployment rate could really start to go up. So, again, thinking about like the 20-year yield, or if you want to look at the 30-year yield or the 10-year yield, whatever it is you want to look at, as long as it's dropping, it sort of implies that the economy is slowing down and that the Fed has done enough and they really need to start cutting soon in order to keep us from going into a recession. If it were to start to bounce back up, then the implication is that the Fed has pivoted too quickly. And if the Fed has pivoted too quickly, then welcome to the 1970s, where we had an inflationary decade and we had not one, not two, but 3 waves of inflation. I really hope this is not what happens. And listen, there's a lot of people out there that have all sorts of opinions about what's going to happen and what they want to happen, based on where they think the market is going to go, the S&P 500. But guys, the S&P 500 is one thing, but I really don't want to live through 2 more waves of inflation over the next 5 to 10 years. Think about what it would be like to just do normal shopping. Like, everything would be so much more expensive. If you think things are expensive today, what if you get another 2 waves of inflation, right? I don't want that. I don't think you want that. I hope the Fed has done enough. Because if you look at what happened in the 1970s, yes, the S&P was putting in new highs, but it was also putting in new lows as well. Look at this. A high, a low, a higher high, a lower low, a higher high, and a lower low. The level right here on the S&P at this high in January of 1966, we were at that same level in December of 1978. 12 years later. I hope we don't have to do that. I really hope we don't have to do that. And Powell has said before that in order to really get durably back to a wave of economic expansion, they need to get make sure they get price stability under control. They need price stability. If you don't have price stability, as he says, right, the economy does not work for anyone. So this is the dilemma that the Fed is under. And I think that we can't understate it. We can't overstate it, right? If you cut too soon, welcome to the 70s. If you cut too late, hard landing. Here we come. And remember, the market is mixed. Because as we showed earlier, if it's a hard landing, you're probably going to need more than 150 basis points of rate cuts. And if it's a soft landing, why are you cutting 150 basis points and risking a reacceleration of inflation? So there's a lot to consider. As I said previously, and as it relates to the S&P 500, I said previously back in July that the way this would likely go is that you're going to get a 5 to 10% correction in Q3. From here, you tend to get favorable seasonality going into the end of the year. If we were to overlay year-to-date ROI of, let's just say, Apple, it's already going to be up. Let's just look at Apple, sort of the blue chip, and average out Apple over pre-election years. It's right where it always is in pre-election years. This is where it typically is, right? There tends to be favorable seasonality at this time. This is the S&P 500. Here's the average of prior pre-election years, right? On average, the market trends back up into the end of the pre-election year, right? This is what typically happens. You can see that typically we put in a high in the summer, and then we come down, and then we go slightly above that level by the end of the year. This is what the average of all prior pre-election years shows us. So we've done that. I also mentioned, a month and a half ago or so, that when Yellen issued shorter duration, that was bullish for risk assets. And that was one of the reasons why I was, slightly more convinced that higher for longer had been fully priced in, because Yellen surprised the market by issuing shorter duration than the market was expecting. And that led to a huge sell-off the treasuries were dropping like a rock, right, when this happened. And when you get the long end dropping, that's normally bullish for risk assets, right? So you not only have favorable seasonality for risk assets going, starting from that October timeframe, you also had Yellen issuing shorter duration, and then the last thing that you had was interest rates, the market finally believing that the Fed hit the terminal rate, right? And what normally, as we've expressed many times, when the terminal rate is reached, the market normally rallies when the terminal rate is reached. And sometimes you can get a sell-off kind of going into it, right? But a lot of times the market, after the terminal rate is reached, will get a rally for a few months, right? You can see right here, terminal rate reached, the market rallied for a year before it finally fell off a cliff. And I'm not saying it has to fall off a cliff, but again, terminal rate reached, you get an initial sell-off, and then the market rallies. This is fairly common. So we've seen this many times before, right? This story has been told many times before, and it goes, the Fed raises rates, the Fed eventually gets to the terminal rate, they pause. Upon the pause, there can be a sell-off temporarily, then risk assets tend to go up into that as the market prices in a pause. As the long end of the yield curve falls back down, risk assets generally like that. Where it potentially becomes an issue is if the long end of the yield curve keeps dropping. That is the issue. That is the risk. That is what I think everyone should be watching over the next 6 to 12 months. That is the main risk. If the long end, if the 10-year holds here at 4%, then there's more credence to the soft landing idea. But if it just continues to drop like it did coming out over here after .com and 2008, if it just continues to drop like this, then what happens? The S&P eventually follows it down. So that, I think, is what we have to look at. Is where does the 10-year yield go? Where does the 30-year yield go over the next several months? And if the Fed does start to cut, do they cut quickly enough, right? If this continues to go to the downside, that's sort of the next question is, if we find ourselves where the 10-year yield is at like 3.5% or something in 3 to 6 months, and the Fed's cut 25 basis points, is that enough, to really help the economy out? Probably not, right? And that's why I said before, even 150 is likely not enough if it's a hard landing. And if it's a soft landing, 150 is probably far too much. That's where we are. Those are sort of my thoughts on the FOMC today. And of course, everything we just said about the S&P 500, you could say the same thing about Bitcoin. The reason we don't know for sure is because we don't really have that much data for Bitcoin, right? If you were to look at Bitcoin, it's not like it's really existed through a lot of business cycles. The only one we even have to go off of is this right here, right? The last cycle. And in the last cycle, what happened is that Bitcoin topped just before the Fed started to cut. That's what happened last cycle. Bitcoin topped just before the Fed started to cut. And so there's this big dilemma, right? There's this huge debate in the cryptoverse right now as to what's more important. On one hand, you look at cyclical behavior of Bitcoin, and we are approaching the halving year, and that's on one hand. On the other hand, you can see that before the Fed started to cut last time, which was a sign that the economy was weakening, that was when some of the risky assets started to put in local tops. Not like a major top, not a new all-time high, but a top that lasted until we got to the last rate cut. And so I think we have to be aware of potentially repeating that sort of scenario. It's not that it has to play out. I don't want to give that impression, but we've followed this for a long time. We've said many, many times that in 2019, Bitcoin rallied and it topped out just before we got to rate cuts. And so you have to wonder, is it going to do the same thing again? I don't know exactly when the first rate cut's going to come, but market says March. So, 1 month, this here is January 31st. So if they don't cut here, then you have all of February for the market to really digest whether those cuts are coming and if the economy is slowing down to warrant a cut. All of February. What's interesting about February is it's 1 month after the whole spot ETF stuff might get resolved, whether it's approved or not, right? Because I think a lot of people, I haven't really been following it, to be completely honest, that closely, but I know a lot of people are saying January is sort of the time frame for that. And all of that relates to to how these markets are sort of behaving, and how higher risk has been bleeding back to lower risk until you get to those rate cuts typically, or at least plus or minus a month or two, as I've said before. So a lot for us to consider. I don't want to go any longer. I think I've taken enough of your time. Thank you guys for tuning in. Make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I will see you guys next time. Bye.